Good afternoon. Welcome everybody to this webinar on scaling fintechs with confidence, how risk, governance, and capital evolve with growth. My name is Adriana Vega, and I am the Executive Director at Fintechs Canada. And we're very happy to partner today with the folks at Purves Redmond Limited. For those of you who don't know, Purves is a full-service Canadian commercial insurance brokerage, and they very expertly organized this webinar today that we hope is going to be very helpful to you. Purves are affiliate members of Fintechs Canada, so we're always very happy to partner with the team. Today's webinar is focused on scaling fintechs with confidence. At Fintechs Canada, we know a couple of things about scaling fintechs. As the industry association representing fintechs in Canada, we have over 50 members in supporting Fintechs Canada. We are the advocacy association representing this industry. I'm based out of Ottawa, but our members service Canadian customers all across the country every day. And in our membership, we have both small, emerging, scaling up fintechs, as well as large, well-established Canadian fintechs and global players as well. And oftentimes what we hear from our members are the challenges that come involved with this scaling, and that transformation comes with risk, right? Whether it is the control environment, the governance, the regulatory, as well as dealing with a very fast-moving, innovative business model, as well as capital market milestones. So part of the driver for us to partner with the folks that you will be hearing from today was addressing some of this concern that we hear often from our members, and trying to discuss some of the legal, financial, risk management strategies that we have observed work and help fintechs grow sustainably, stay protected, and of course, maximize the valuation. So I am very excited to hear from this panel today, all experts in their field, all coming at it from different perspectives. So thanks again to the team at Purves for organizing, and of course, our friends at MNP and at TORYS for providing your insights and helping put together this webinar today and making it a reality. So just a quick introduction of everybody whom you're going to be seeing on your screen. On the Purves team, we have Mert Guler, who is partner. He is an advisor to boards and executives on risk and governance. Sean Gibson, also partner at Purves. He is senior client executive. He leads the firm's technology and transactional risk practice. Moving on to the MNP corporate finance team, pleasure to introduce Pedram, who is director in capital advisory. He advises mid-market companies and financial institutions on debt and equity structuring, refinancing, and private capital solutions. And he's joined by Peter Yien, who is also partner on the risk and technology solution side. And last but not least, Brigitte, who is also in Ottawa. So Brigitte, it's always a pleasure to introduce you to these events in person and virtual and otherwise, because it's always wonderful to come with your expertise. For the audience, Brigitte Goulard is Senior Counsel with TORYS. She co-heads the firm's consumer protection practice and the Fintech group. And of course, Brigitte has a lengthy career in the industry, holding numerous roles. But of course, I always like highlighting she is the former Deputy Commissioner of the Financial Consumer Agency of Canada, so brings a wealth of expertise on the regulatory side. So without further ado, it's great to join you guys. Looking forward to the discussion, and so I'll pass it over to you, Mert. Thank you.
Thank you so much, Adriana. Really appreciate it. It's just an absolute pleasure and honor to be here. Thanks to Fintechs Canada, and I'm the luckiest moderator in town because I've gotten to know all the panelists. It's an honor to be with Brigitte, and I've learned a lot from every one of you, and I'm looking forward to having an interesting conversation and really insightful. One thing that I thought I knew about business and the world was that often growth was a little bit at odds with almost its kind of growth versus risk management, governance, compliance. I thought they were a little bit sort of attention or opposed to each other, but I think my good friend Pedram is going to be telling us some interesting research from MNP that says that it's not growth versus compliance and risk management. Pedram, could you tell us more?
Yeah, absolutely. Thanks, Mert, for that generous introduction, and great to be joined by this panel as well. So I do have some content, actually, believe it or not, which I think can anchor our initial part of this conversation for the next hour. But yeah, Mert, you're absolutely right. When we're looking at risk and compliance, it's not necessarily a trade-off to enterprise value. It's I suppose it's intuitive to some extent to say that a well-managed business, a company that manages its risk, and certainly it's the case in financial technology companies that have to manage even more risks in terms of the regulatory front, in terms of all the compliance that they have to do in dispositioning their services to their customer base. The question of compliance is actually central to their value. And one way to look at it is, as a fintech, ultimately you're driving towards some kind of an enterprise value event where you lock in that value that you've built as a founder as you've scaled. And so, you're maybe looking at an exit, a buyout from a large bank or a private equity firm or what have you. But the point is that on that journey, there's two stories happening. There's the exit multiple, which is what you're trying to target, and fintechs generally and financial services companies command a pretty good exit multiple generally. But then at the same time, you're trying to balance the spend on compliance and risk management, internal controls. And really the trade-off that you're talking about, I think, happens in the convexity, which is in this graph here. The convexity between how the scaling relationship of spend in compliance versus where you get to in terms of enterprise value later on is different. In terms of enterprise value, you get premiums to scale. So that curve is convex, which is the orange line in that graph over there, as you can see. As you get bigger, the exit multiple generally tends to start to curve up. Whereas, on the other hand, your investment in internal controls and risk management might be slightly convex or flat. Like, as a proportion to your enterprise value, you're gonna kind of spend a linear amount of compliance spend. So what does that mean? That means to say that yes, while you're building up, you might be so focused on rapidly implementing new new technologies, innovations, and maybe you've put your internal control regime, your SOC compliance, all the things that you have to do, managing your insurance paradigms in the back burner. What I'm trying to suggest here is that that might not be the wise strategy, and I think that this, if we look at this as a concept, and then we try to look at what's happening in the market, which is I'm going to go into the next slide here, we can see a very good correspondence between those companies that have a robust internal control risk management regime and how they fare in terms of their multiples, their mean enterprise value to EBITDA, versus companies that don't have that kind of a regime in place. Now, in this case, what we've used here, what MNP's research was based on, is using SOC reporting as a proxy for internal control maturity and risk management maturity. That's just one way to look at things. We could have picked, you could pick other things, but SOC reports are generally observable in the market, and so you can see here that fintech companies with a SOC report trade at 24 times. The average of this grouping is about 11.6 times, and so there's certainly some correlation here. And I have to be fair that it's not causation. Sometimes big companies manage well, just trade better, but of course, to get there, they need to manage risk properly. And so, that might be the case. But at the end of the day, there's clearly a premium for these companies that have this kind of control maturity in place. And so I think, anchoring our conversation for the next, 50 or so minutes, I wanted to start our thoughts on this, is that this should not be risk and compliance in the pursuit of it should not be something that's a pain in the butt, but it's actually core and strategic, and it does translate directly to enterprise value.
It's an amazing insight, and you're right. It's intuitive. Probably most people understand that they're related: enterprise value and good governance and risk management. But the fact that you've put together this kind of research and shows 81% premium, valuation premium is a really important insight. All right, Pedram, can you talk about, is this because of, larger these companies with better SOC audits or better compliance are getting larger contracts, more sophisticated, larger clients? Are those some of the reasons why the valuations are higher as well?
Undoubtedly, that has to be an aspect. So, why are they trading at a higher premium? It's because the buyers, the investors that are looking at, picking between option A and B, one company that has further to go on its risk journey, on its risk management journey. There's just that much more spend from the buyer's point of view that they're going to have to make those investments to get this company to a mature stage. Whereas if a fintech has already done the work necessary, then to some extent you might say there's an arbitrage opportunity where the investment, going back to the original curve, those two curves, it's like the investment that you did at an early stage in compliance, it grows with the company. So it scales with the company. It's harder to set up an internal control regime when you're already pretty complex and large versus getting it going at the beginning. And so those companies that already have it and it's part of their ethos, it's conceivable that they're getting an exit premium, or they can negotiate an exit premium that's above the investment that was made in that maturity journey.
That's excellent. What a great way to start a conversation. Some really great insights around governance and risk management as we scale. I was also speaking with Brigitte, and I've learned some really interesting things from Brigitte as we spoke back and forth, and she's really opened my eyes towards the complexity and challenges in this world with unprecedented technological change. I understand Brigitte's going to tell us about some pretty significant regulatory changes that are coming down quickly, and how regulation could also be viewed as something that could help companies innovate and develop a competitive advantage. So, Brigitte, please tell us a little bit about what you've been finding.
So yes, thanks, Gert. And before I forget, so maybe we can go to my slide, which is the next slide. Or maybe it's there and I just don't see it. That's possible since I'm not in the same room. Can someone tell me if you're seeing this?
We see it here, I think.
Okay.
Oh,
there we go. Okay, sorry about that. Want to make sure I'm talking about the right slide. And before I get to all of these regulatory frameworks that you see on the slide, Pedram, I can't stress more or agree more with you than with your comment about how important it is to start right at the beginning, even if you're small and you're not yet sophisticated, because starting compliance, dealing with compliance when you're large is extremely difficult. So, and this slide here shows why it's difficult. So these are all the regulatory frameworks that could potentially apply to a fintech, depending on their activities and what their business plans are. But I have separated them here. Here we see, how many do we see? 6, 7, 8, 9. And I think it's important to divide them up in terms of those that are targeted to financial services. So the Retail Payments Activities Act, many of the fintechs that are payment service providers are very aware of this new legislation that came into force last year, and that is overseen by the Bank of Canada. So for those of you who are dealing with that legislation, at least you have an idea of what might be coming, of at least what's coming with the RPA, but what's coming with other types of legislation. If for those fintechs, and right now there's about 6 of them that have now access to Payments Canada as a member, are members of Payments Canada. And I put payment modernization because there's membership in Payments Canada, but there's also the real-time rail that is coming that will have additional eligibility requirements in order to participate. So a bunch of rules there that you need to comply if you're a member, and you need to comply if you want to have access to the real-time rail. Also supposedly coming this year on a website near you is the Consumer-Driven Banking Act. So those fintechs that are thinking about using the Consumer-Driven Banking Act, to be able to offer open banking to their customers, or as at least partner potentially with a large FI in terms of facilitating the larger FI in offering open banking services. You will need to have to deal with the Consumer-Driven Banking Act. Still in the financial services world, there's the Stablecoin Act that is also coming. We saw there were some parts of it in the last bill, so there'll be more coming this way. And then we're getting in terms of other types of legislation. So I'm thinking here, for example, of AI and privacy. Often AI and privacy are kind of linked, but they're not quite the same. We already have privacy legislation. We have some at the federal level, and many of the provinces also have privacy legislation. So a lot of the fintechs are dealing with consumer data. If you're dealing with consumer data, you're already aware of the privacy requirements. We haven't seen AI legislation yet. We've been told it's coming, at least at the federal level, so pretty soon we'll see an additional regulatory framework that will be imposed. Most fintechs deal with AML, which is the anti-money laundering legislation, and those requirements are also quite onerous. FinTrack has been known to issue some significant penalties, so something to be very aware of. And I'm sure most of the listeners are already aware of the AML legislation. Some of you may not be as aware is the provincial consumer protection. If you're offering services or products in any of the provinces, you're subject to provincial consumer protection requirements. If you're partnering or yourself offering credit type products, those requirements can be quite onerous in terms of disclosures. And finally, if you are partnering with a bank, either offering a bank product or having the bank offer your own products, you also need to comply with some of the Bank Act requirements, depending on the type of relationship you have. So, earlier we mentioned that, Adriana mentioned I've been working in the financial services sector for a long time, and I've been in the sector actually for close to 35 years. And, if I've had to put a slide like this of what it looked like when I started, there would have been probably one box. So it's becoming a lot more complex, extremely interesting, the developments, and it will lead to more innovation, but it does impose an additional compliance burden on fintechs which may not have the staff to deal with that burden, or may not necessarily understand all of the links between those, because they are all interlinked. When I answer questions for clients, I have to consider the impact on every single one of those legislation. So that, in a nutshell, is the regulatory frameworks that the fintechs will have to comply with, depending on their activities or their plans. Bert, did you have any questions for me before I go to the next slide?
Yeah, no, it's almost a little bit overwhelming, especially for some fintechs that are still earlier, newer in their growth path. How do you help them make sense of all this? It must be a real daunting challenge for you and your clients.
So I think what's really important and what's changed over the years is, at the beginning of my career, and I worked, I wasn't always with a regulator. I worked for a long time in the financial services sector in-house, is that, products would be, the strategy would be developed, then they would go to the product people and they'd say, oh, this is the strategy, can you develop the product? And then they would get to the lawyers and say, this is our product, what do we need to do? That has completely changed. And now I would say that the legal issues, the legal requirements need to be right embedded in the strategy. And I'll give you a couple examples. You're a new fintech. You're developing a product. You're developing a service. And your strategy is, oh, we want to be able to partner with a bank and eventually potentially sell to the bank. And, this is all great, all done. They go to the products people, they go to the technology people, everybody's fine. And then they get to the legal people. And the legal people say, oh, it would be really good if you could have in your product offering complied with the technical standards so that we can comply with the Consumer Driven Banking Act, because the banks will require us to have those technical standards. Well, if you haven't thought of that right at the beginning, you might have spent a lot of money that you now have to respend because you haven't been compliant. Another example, you want to be able to offer a product to some of the banks, but in your products, you don't include some of the disclosures that are necessary. Well, you have to go back to the drawing board and start again with the product development. So, and these are just like two small examples of why you really need to think about the regulatory implications at the strategy side of things. I'll give you another very an example that happened not long ago. So a decision was made internally at an FI. Oh, we're going to amend the clause and increase the price by X. They amend the provision, they increase the price by X, and then they come to us for an unrelated question, and we notice this and we go, oh, you know, in Quebec, there are some specific rules that you need to comply with if you're going to amend an agreement. Did you comply with those? Oh, we didn't know about those. Well, now there's a whole big issue of potential class action risk, which some of you may know is not a good thing to face. So it's so important to understand exactly what the legal requirements are before you start making some of these decisions.
That's fantastic. That's fantastic.
I can't stress this enough, because so many times I've winced inside when a question's been asked, thinking, "Oh, I wish you would have called me like 3 months ago." You know.
And as your example about a company that might be one day thinking about getting purchased by a bank, what a great example of Pedram's point also of how compliance and thinking about these things early can really increase enterprise value, because that example would really hurt that business.
Oh, I'll give you another example. A number of years ago, like we often, you know, TORYS is very well known for its mergers and acquisition business, and us regulatory lawyers get involved to make sure that, you know, the company being acquired or sold is complying with, you know, the requirements of the purchaser or the of the seller. And within the space of a few months, I was looking at a fintech who was clearly thinking about partnering or being acquired by a bank, because they were complying with all of the necessary Bank Act requirements. So our due diligence was like, oh, this is great, you know, check, 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 you know, no problem, go ahead, you don't have to worry. Versus another fintech that we were also looking at for due diligence, who had not been thinking that way. And there was no check, 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 check on our due diligence list. It was a list of things that the fintech needed to do or the bank would need to do in order to be able to continue, you know, working with that particular fintech. So important to understand exactly where you want to go.
That's absolutely fascinating. These are amazing examples. I wanted to move and have a question for Peter. Is there anything else at this point you wanted to talk about now, Brigitte?
No, I have a couple more slides, but we can.
Oh yeah, go ahead, Brigitte. Go ahead. Yep, sorry. Go ahead.
So these are just two quotes to say, you know, regulation does not just follow innovation; it shapes the manner in which you build ideas. It shapes, like, you know, I look at how open banking has been in existence now in the EU for a number of years. There was an explosion of payments related services and new tools for budgeting after there was regulation. So regulation doesn't always, you know, kill innovation. It often drives innovation. And these two quotes show that. And my last slide is basically, you know, regulatory compliance helps. It doesn't create any more issues. It really, if you're thinking about scaling up, think about how do you need to comply sooner than later. That's my last slide, but happy to answer any more questions as they come up.
Brigitte, as a company, of course they have to comply, but as they go through the process internally, strategically, how do you recommend fintechs engage with regulators and speak to regulators?
Yeah, that's a good question. Like, for example, if you're thinking about developing a new, like, for example, RPA, and you have some questions, you're going to have to comply with the RPA. And you have some questions with, the RPA, you can call the Bank Act or the Bank of Canada, who is the regulator. I think it's very important that you engage in that. If you see that there's some potential issues, well, you consult with counsel, either internally or externally, but you need to engage with the regulators. One of the good things in Canada is that the regulators here are a lot more amenable to assisting some of the regulated entities than you see, south of the border. So absolutely engage with the regulators, understand where they're coming from. The Bank of Canada has some amazing documentation on their website to understand the RPAA. So understanding the regulators' expectations is critical in order to be able to set up the right compliance framework.
Absolutely, Brigitte. Thank you. Thank you for sharing that. We clearly understand the importance of compliance. I mean, it's required, but also there's strategic reasons around the benefits to enterprise value of a really thoughtful, strategic approach to governance and risk management. Peter, I understand you are very knowledgeable about especially SOC audits, SOC 2 audits and compliance. How do we take these very important strategic understandings and insights and operationalize them in a fintech?
That's a great question. Let's look at the slide at the top. We're talking about benefits. Most people, when they look at SOC, they start on the left. They don't start on the right-hand side. The right-hand side of a strategic. What do you want to do? If your goal is to ultimately sell your business at 2 times a regular multiple, your decisions would be quite different than if you just want to build a business from scratch. There was this slide that Pedram showed earlier, that inflection point. I think it's really important to know when you would get started and how fast do you need to get started before you fall behind. I always use the example of a break-in in a street. There's no break-in. You're good, but you're always watching for it. And you start to see some signs of things that are strange. People that you don't know that are driving on the street. Are those signs that you actually would say strategically, I need to think about buying some insurance? And at some point, you actually say, I heard that there was a break-in. I better buy that insurance. And most people, you know what they do? Their house is broken into. I think it's time to have an alarm. So the question is, where is the alarm in this? And I want to walk you through, most of my clients, they go through this. The acronym is mine because I always ask my clients, when do you decide to commit? And when do you actually commit to something? And strategic is never the question. It always starts with contractual needs. One of the clients is saying, hey, I need you to have a SOC report because OSFI is falling behind my back. I'm a bank and I can't use you anymore. So can you just get this done for me? And this happens at every institution where I've done they do this just for one client. And that's the contractual need. They have an existing contract. They got to get going or else they'll lose it. And it's big, really big. The next one would be, oh, well, wait a minute. Since I've done it here, maybe this will allow me to respond to an RFP. I may be able to position myself slightly ahead of somebody else and maybe able to get that second client. That's not strategic at all. That's just reactive. The next one is you have an existing contract. They're now saying, we're terminating you unless you can get this. Now, this is really serious. The first one was, hey, we want you to get it because there's a contract. It doesn't spell it out. There's something in there that either they're changing that contract or they're saying, you're just done because we have no choice. We can't use it anymore. So you're now mandated. That's all good. Most people operate in that sphere. What you want to get to is the right half, where you have some idea that you want to be mature. And the reason why you want to be mature is more than just compliance with existing requirements. It's going to allow you to take market share. It's going to allow you to drive efficiencies. A lot of these controls will result in efficiencies because it involves automation, which we haven't talked about yet. But that automation piece is going to actually get you further down to innovation because you're now saying, hey, wait a minute, I'm making things go faster, but it's presenting errors in a faster way. What's causing these errors? So you're fixing the errors, and then you apply innovation to it. Well, guess what? You are now eliminating the errors, and you're innovating. And then finally, this is part of that tactical plan that I talked about. Maybe it's just to take 50% of market share. Well, the faster you get there, the faster that ramp is, and that inflection point has already happened by that point, and then you get strategic. That strategy is about going to bank or anybody else and say, I'm your sole supplier. I'm going to deliver all your services. That's great. Or I'm going to take the entire sector, the entire industry, and I'm going to be really good at it. That's the benefit. I'm going to just drive on the right-hand side, and then we can always address some questions. What does this all mean when you finish the SOC report? On the bottom right-hand corner, there's a thing called Trust Services Criteria. If you look at the purple, a basic SOC report has security. If you want to engage and you want to get a SOC audit done, that's it. The other stuff optional. So we talked about, for example, privacy. You could do that. You could include privacy, but you see privacy sits on top of confidentiality. It means you have to get confidentiality and privacy, and that's how you get to privacy. And on the left-hand side of that bottom right-hand quadrant, you see availability. So how do you have controls to ensure that your system is up all the time in accordance to the contractual requirements? If it's 99.9, is it really 99.9, or is it somewhat less than that? And then there's a lot of fintechs out there that actually do some sort of processing. They manipulate the data, they ingest the data, they validate the data, and then somehow they provide some sort of dashboard or some sort of results so that the API can correspondingly pull that information back into your client's systems. So that's process integrity. So that's kind of the pieces that lie in between. I want to pause there for a minute just in case there are questions.
Peter, it's very interesting. What I want to know is, even I can understand why this would be important to prevent losing a client or to get new clients. I understand that. Are there some other signs that a founder or executives would know that we better start thinking about doing this, or it might be almost getting too late, but before it gets too late, we want to do this?
Absolutely. I would say probably just simplified, there's probably 3 things. A lot of fintechs gets asked to fill security questionnaires. Those questionnaires take a pile of time. What's worse is you fill a different questionnaire for every single client. And the maintenance cost to do that is huge. Secondly, they're not consistent. So what happens is if you are at the liberty of needing to fill a questionnaire from a specific client, you may be asked to do a million things. At least with SOC, you can say I comply with a well global accepted standard, and I comply with all the elements. That actually can be a cost saving to you. One of my clients actually was asked by Microsoft to fill out the questionnaire. And for those of you that are online, if you've seen this, it is cumbersome. It takes you weeks to complete this. And of course, there's questions in there that actually ask you, hey, do you do A, B, and C? My client was saying, well, that's not applicable. Well, you have to explain why it's not applicable. And that itself takes time. And they decided to do a SOC. And after they do the SOC, Microsoft takes a look at it and go, this is a widely accepted standard. And they specifically spell out you had to cover security and availability in this case. And they did. They got a clean audit opinion. Microsoft went away. And when you kind of measure the maintenance costs, if they had to implement additional systems when they're not applicable, or else Microsoft is not going away and you're always going to be challenged to say, why not you doing it? It actually can be a cost saving to you as well. That consistency and not having to fill out the questionnaire is a huge saving.
Peter, I love the concepts of automating efficiencies backed up by what Pedram's talking about in terms of increased enterprise value. I'd like to move on to Sean. Sean, we've talked a lot about risk and governance and risk management. I know a little bit about you, Sean, but how do you suggest clients think about, businesses think about risk management?
Yeah, well, great question. Thank you, Mert. I think that companies, fintechs, especially as they scale, they need to pick a path. We've heard the words ethos used a couple times today, looking at compliance or risk management as a pain in the butt. I'd call it a necessary evil, for a lot of these companies. But I think at some point in a company's evolution, they need to think about what they're doing from a risk management standpoint and from an insurance program standpoint, and why. Like Peter's slide just a few seconds ago, insurance at an early stage is usually driven by contractual needs. And your client requires you to have X amount of coverage, so you buy it. And you buy it because it's a cost to doing business. It's a necessary evil. It impacts your top line, but you've got to do it because you need to bring in revenue, and you need to keep growing, and you need to keep having customers and being able to operate as a business. And at some point in a company's evolution, there should be a shift, or there's a natural shift between doing the bare minimum in order to operate and bring in revenue, to looking at insurance and risk management as a way to bulletproof their business, to protect their balance sheet, so to speak. And interestingly, we can see this with many different companies where they've moved into quite a mature stage, and they've never really sat down and thought about how they're approaching their insurance program. So they could be, $1 billion in revenue with, hundreds or thousands of employees, and they have a very simple insurance program that is really just allowing them to bring in revenue, but isn't protecting the business as a whole in the event that there's a calamity. And in the fintech space, we're usually talking about a breach in cybersecurity that causes their tech product to cease functioning. And what can happen is you can have a program that's just kind of dragged along from the infancy of the company through to a mature phase, with nobody really taking a look at how it's been designed or what it's meant to do. And you can have a disconnect between what it is and what management or leadership thinks it is. And that's where a company can really run into a little bit of danger, where there's never been an analysis about what happens if there is a major breach and their operations go down. And there's a thought that, well, insurance is there, we buy it, but there's been no analysis into what actually happens to their company if they go down. And you can have leadership assuming that they've got a program that is going to protect them, but that's not actually what's been purchased. What's been purchased is the bare minimum to just allow them to operate and service their contracts. So I think at some point in a company's evolution, and it's okay, it can go either way. You can be a mature company that decides not to buy a ton of insurance, or you may have a risk that's effectively uninsurable. What's important is that a decision is made and an ethos is chosen and a company goes forward on an eyes wide basis, right? So as an example, if I may, I long-standing client, they had a change in leadership and they had a good look at their program, and they had just been buying the bare necessity to allow them to perform. And we got into a long discussion about what would happen, from an aggregation risk perspective, if they started to breach all of their contracts with their clients, if they ended up going down. And it turned out that the risk is too big. It's effectively uninsurable in the marketplace. So instead of going and buying more limits and spending money on more insurance, they would be much better off hardening their systems, right? That would be a much better use of their money than just buying, a couple more policies, so to speak, right?
Integrating risk management thinking and
Exactly.
insurance. Yep.
It's not just about buying more insurance. It's about having an ethos and an understanding about what you need to do to protect what you've built.
Do you have in your experience any examples of, as a company grows, scale substantially, and how their sort of thinking evolves?
Yeah, for sure. I mean, certainly the one I just gave, but we've definitely seen companies that move into a mature stage, a more mature stage, when they decide that, we need to completely revamp the way that we've approached risk management and we've approached our insurance to right size it for the organization that we've built, that exists now, today, and actually look at the exposures that the company faces and insure it on that basis.
Thank you. Let's do a little bit of round robin style. So everyone here has talked about governance and compliance and risk management. Let me ask, maybe start with Brigitte. Brigitte, how does institutional capital, private equity, how do they view and test governance and risk management when they get involved in the big picture?
We have seen them. I've been at TORYS now for about 7.5 years. So I haven't spent my whole life here, but I've been involved in a number of those types of arrangements where we're asked by venture funds and so on for an assessment of their regulatory of a I guess an entity's regulatory compliance. And like they want us to go deep. This is not, kind of, is it a thumbs up or is it a thumbs down? Like they want a report where are potential issues. They want to understand what the issues are. They want to understand if there's a potential issue of class action. They want to understand the class action risk, how to mitigate those risks. It is an important function from what I've seen, where I've been involved, that the body that's been asking for additional funding or that is asking for investors, that they comply. Like it's not something that is overseen by investors.
No. Thank you. Pedram, how about yourself when there's a possible liquidity event on the horizon or a company is financing and looking for growth capital or private equity? Do you see any requirements or questions being asked by institutional investors?
Yeah, without a doubt. So, a lot of the fintechs that I've dealt with from a credit deployment side of things, they're specialized, let's say, mortgage lenders. They found a niche in the market where their technology platform services a client community a little bit better than the banks. And so, it's kind of like monopolistic competition where you're doing the same thing but slightly differently. And so, invariably you're going back to the banks for warehouse lines of credit. It's probably a cheaper way of raising capital to deploy a strategy like that. And what the banks are asking for is, if we're gonna lend from our balance sheet to a business that we would do ourselves, we're gonna subject you to the same level of regulatory maturity that we would be under, because essentially from a credit risk perspective, they're taking on the same level of risk, right? So at that point, you can't just rely on the technology stack or the clever marketing that you've built your value proposition on. You have to actually demonstrate that, we can provision these clients the same way that you can, and we do it better because we have a technology solution that's peculiar and well thought out. But the table stakes, which are all the AML and the KYC and all that other stuff, sufficiency of insurance, whatever the case is, it needs to be there. Those conversations invariably come up, and it can be mission critical because, in this case, if you can't get that warehouse line of credit, let's say, you're going to be, materially behind the profitability of your peers. So somebody else who's doing it that can do it for cheaper because their cost of capital is lower, because they can access that capital because their risk management is at a good level, they're gonna go ahead of you.
That also impacts enterprise value too.
Absolutely,
so,
of course.
The tie-in continues.
Yeah, to Peter's point, it's what can you win, and what are you going to lose by making that trade-off of, okay, well, you know what, risk management is something, it's a necessary evil, versus risk management is a core part of our strategy. And risk management is this broad thing, it's sufficiency of insurance, it's maturity of internal controls, it's getting the social proof via reporting that Peter signs off on, that you can demonstrate and send to the market. It has a direct bearing on access to capital.
And even if there's like a little improvement that could be made that would satisfy the institutional investors or the venture funds that are prepared to invest, it takes time. Like I was involved in one where there was something missing from under British Columbia consumer protection legislation, and it was just a question of slightly amending one of the agreements in order for them to comply. But that takes time. So if you're crunching for time, and they may say, yes, we'll provide you with the funding, but you need to correct that first. The correcting that first may take at least a few months. So it's not just the question of, do you have the risk, the necessary compliance or risk profile, but what do you need to do and how long it's going to take to get to that point.
Thank you, Brigitte. Brigitte, let me also ask, are you seeing any changes lately in the amount of due diligence or the expectations of institutional investors or private equity?
Like I've said, yes, I have seen more detail-oriented work, more details in terms of wanting to get into more details. Like, for example, the one I was talking about of, are they complying with all of the provincial regulatory requirements under consumer protection legislation across Canada? We spent, hours looking at all the agreements, making sure that they're all compliant. So I would say it's much more detailed than it used to be.
Peter, is this showing up in your world as well?
Yeah, it does. What's really important is, anytime when a company's either they go public, IPO, or gets acquired by a private institution, one of the things that quite often ask is, what kind of bag of tricks have I bought? And we talked about risk management. I think it's taken a really bad name. I think it really should be opportunities maximization. I give you an example. If you want to live till 95, that's an opportunity. If you don't care, then there's nothing to maximize. So then the question is, how do you maintain your body to last till 95? For a company, it's exactly the same. How do you maintain your company to be strong where you have the good controls, good processes? When you get to that very last funding, that very last purchase, they're going to say, we are worth it. To what Bridget's saying, check, 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 check. It's too late. By the time you're 95 and say it's time to exercise, good luck, right? So the exercises you got to prove is you've got implemented controls in place. You've been exercising those controls throughout the life of that organization to the point where you can do it in your sleep. And therefore, I always go back to big organizations where, if they use a fintech, they can no longer say, my fintech does that for me, it's not my responsibility. That doesn't get accepted anymore. So if tomorrow you take a raw bank, if they've outsourced their pen testing to somebody else and they got a breach, they can't say, well, it's that company. No way. So that's why big companies, small companies, they always say, well, if I'm using you as my fintech and you're doing something for me, I expect you to do the same things that I would do. And in fact, I might expect you to do more because there's a reason why I'm outsourcing it to you, because you've got the economies of scale to do things I couldn't even do myself. And so on the risk management piece, it becomes really important. I will caution, I don't know if there's very small fintechs that are sitting out there right now. Some of you don't have a board. Some of you have just the founder sitting there. That's great. But as you start to grow and grow and grow, you end up being very myopic, and I call it familiarity risk. You start to not see anything wrong in your business at all, because you're so familiar, because everything seems to work. That's where this SOC thing that I was talking about, having that, actually I haven't talked about it yet. On my previous slide, I missed something on the bottom left, and that's R1 and 2. It's very simple. R is, are you ready? 1 is, are you ready at a point in time? And 2 is, are you ready 2 points in time and forward, like months and months and months. And for those of you that kind of say, well, I don't know if I want to spend all this money on internal controls, you can do a readiness assessment. It's kind of like, am I ready to drive? Do that. You don't have to drive tomorrow. But if you say, well, if you want to be ready to drive, you got to do A, B, and C. Like, for example, I need to be able to turn on my full self-driving. That's going to be a skill that's necessary down the road. And if you don't know how to prompt your car to go where it goes, it can't. But do you have to worry about today? No. So you then, from a risk management or risk or opportunity maximization, and saying the moment when 50% of the cars out there requires you to know how to prompt an FSD, it's time to take a lesson. And so these organizations, I feel, when you're doing a SOC audit, it's very similar. You don't have to go all the way. Just see if you're ready. How far of a gap do you have? And identify at what point when you see something, you have to now remediate that gap, because it is now going to get in the way of getting into an opportunity. And I think that's what
really good points.
Yeah, if I could jump in just for a second and piggyback off Brigitte and Pedram and Simon, when I think about some major events from a risk management perspective, especially at the board level, I think about an IPO, right? Especially an IPO on a U.S. Listing, and how much of a change that is for a company from a D&O perspective, insurance perspective, how expensive it is, how much more underwriting scrutiny there is, and like how much bigger the stakes are for the company when they're undertaking that type of event. And something that Brigitte said earlier really resonated with me, which is time is so important. Like, if you're in a crunch for time, we have seen this. My friend, my colleague Mert and I have seen this many times, that insurance is often the last thing that's thought about in these types of events, right? And we're talking about time, risk, and cost. And when you don't have time, your risk is going to go up, but your cost is going to go up significantly. And from a good management perspective, when you go towards some of these large events, if you can just pull back 6 months, 2 months, even 3 months, and just think about what you're going to need to do ahead of time, that your insurance program is going to need to change substantially around these big events, right? Approach it 3 months in advance, not a week before the event, because a week before the event, it's too late. You're going to pay through the nose, and you may not be able to accomplish what you want to accomplish. So I agree with all of you, my esteemed colleagues, is really what I'm getting at.
And if I could, I should have said this earlier to the audience at home. Please go ahead and type in any questions. We still have some time, so please feel free to shoot out any questions, and we've got time to answer them. As we wait for some questions to come in, maybe I could just ask. Somebody said it earlier, the word bulletproof. If I was an entrepreneur or an executive, I want to bulletproof my business, of course. I've now also learned that risk management and governance do not have to be invested in at the expense of growth. That they're all lined up. There's so many different priorities. Technology is changing at a breakneck speed. There's so many more regulations. Regulations are getting more complicated. Can you give sort of one critical priority or one critical thing that an executive or a leader or founder should keep in the back of their mind as they go through the next 12, 18 months dealing in the current marketplace, and maybe with a view towards a liquidity event or institutional capital coming in? Maybe I could start with Brigitte.
So, as I've mentioned right at the front, is think about the regulatory implications at the strategy stage. If your strategy is down the road, you want to partner with a bank, or you need funding, or you want to be able to sell to a bank, figure out now what that plan is, because you need to also realize what requirements are going to apply, and what are the implications from a cost perspective, a technology perspective, and a time perspective, because compliance can sometimes takes a lot of time if there is technology involved and you need to make some changes. So don't wait till the last minute. Implement compliance requirements at the strategy stage. That's my
Very good insight. Yep. You don't have to be a very large enterprise to talk about these critical strategic issues.
No, you can be as small as possible or as big as possible, but absolutely, right from the start. If you think open banking, you need to look at that legislation today.
Absolutely. Thank you, Brigitte. Maybe I'll start with Pedram on my far left. What about yourself, Pedram? What are the key priorities that a leader should be thinking about?
Yeah, thanks, Mert. I think I'll just harken back to kind of the M&A discipline. I know the table here is risk management experts. On the transaction side, I think every founder, every fintech leader needs to understand what their company's worth. In the conversations I've had on the market, the executive at these companies, or founder-led companies generally, they get so focused in on their solution. They're like, it's the next big thing since sliced bread, and what that says is that they don't have an understanding of where they are in the competition. So benchmarking is key. Understanding value is key. Understanding where you are in that journey is key. And then from that, going to Brigitte's point, starting to understand where the areas of potential weakness or opportunities might be to help improve and maximize value. But that starts from a market-driven understanding of what it is that your enterprise is going to trade for tomorrow, let's say, and then you kind of working backwards in terms of what kind of enterprise you want to be and where you want to trade for in the future, and that will go into all of the things that we've talked about today.
Okay, thank you, Pedram. Peter, what about?
Yeah, for me, it's a 3-step process. Being risk intelligent. The first thing is being strategic. What are the things you can't afford to lose? A lot of times we're distracted by a lot of things we could do to make the company better, but at the end, it doesn't impact anything. The second one is, how many times can you lose it? Sometimes you lose one and that's it. That's game over for you. And then very end, many of the fintechs are looking at an exit strategy. Is this going to make a difference for your exit strategy? And if it is, at least know when you need to do it. If you don't want to do it now because of capital constraints, it's okay. But there's a break-even point and there's a risk point, in which case you've seen enough and you got to go ahead. You need to know that ahead of time. So you can't wait till a breach in your system and decide, I think it's good to do some pen testing. It's a little late. But if you know that your industry is vulnerable, that's something you would do. And if that's something that's going to affect your price premium, if you are fintech, you would do it now. So, and the last thing is frequency. How often should you do it? Sometimes you could do it way too often because it's not economical. So you need to balance all those three.
I hate to be repetitive, but I just agree with my esteemed colleagues so much in that, you know, engage with your professional advisors early. Let them help you plan a path to success instead of bringing them in to fix problems. You don't have to know.
Very good, very well said.
You don't have to know everything about everything, right? Brigitte knows everything, right?
No.
I mean, I know a little bit about insurance, you know. Peter knows a lot about SOC 2s, right? I mean, you don't have to know.
Pedram knows about getting 81% higher face value.
But that's what I would say.
Yeah, that's great advice. And a question just came in as well, and I think, Brigitte, we're going to need your expertise on this question. With the Stable Coin Act coming online, is there a blockchain network looked at or maybe preferred by or being investigated by the Bank of Canada?
I have no idea. See, I don't know everything.
There you go. Kevin, there you go. Kevin, there's no other questions coming in right now. We're almost out of time. I've learned a lot from this, and especially the thing that I'm going to remember forever is that growth is not at the expense of being smart and prudent and well managed and well run. And Sean, as you said, I'm clearly aware that I don't know everything. I'm well aware that I don't know everything, but it's really good to have trusted advisors around me. So having trusted advisors like all the people here today to help with these increasingly complex, challenging problems, regulatory issues, and in an environment where forget regulatory change, technological change, I can't imagine technology changing faster, but it's probably going to get faster change-wise. I want to thank everybody on the panel today. Adriana, thank you so much to Fintechs Canada for making this possible. Thank you for all of your support. To TORYS for letting us come in here today. To our good friends at MNPs. To Brigitte, it was an honor having your knowledge and experience involved in today, and all of you. Thank you so much.
Thank you.
Thank you.
Thank you very much. Bye-bye.